Hi, everyone. Welcome to Product Breakdown, a weekly podcast where we break down new products every week. Today, we have a very special guest, Shubham. Shubham, welcome to the show. So, what have you been up to? And tell us a little bit about yourself.
Yeah. Hey, Mayank. I'm so glad we're doing this. I don't even know how many times we've tried to do this and it didn't work out, but I'm glad I'm here today. So a little bit about me. I'm an engineer by trade. I work with Amazon. I'm an engineering leader there. I work with Amazon Ads. I'm also pursuing my executive MBA at Yale. And when I get some time, I just spend that time with my two boys.
My
This
God.
summer, we've been just traveling, having fun. That's pretty much it.
My God. You have kids, you work at Amazon, you are doing an MBA at Yale. I don't know how you manage all that. But anyways, welcome to the show. I'm, again, super excited. The topic I had in mind today was about Bnpl, Buy Now, Pay Later. I think we have been talking about this offline over some calls for a few weeks now. And I think you did a lot of work on this topic at Yale as well. We've seen some crazy news coming in. The valuations have gone down by 60, 70, 80% of these companies. Affirm is down, Afterpay, Klarna. Klarna is down significantly in terms of valuation. So these companies saw a sudden rise in this concept of buy now, pay later. They found tremendous growth. And now we're seeing a sudden decline. Let's talk about this product. What's going on here? And what is their product strategy? And what is the future?
Yeah, awesome. Definitely. I've used it myself and I'm excited to talk about how I purchased my Peloton bike using Affirm.
Brilliant. So, folks, what is buy now, pay later? Let me explain that briefly, and then we'll jump straight into a strategy and a lot more there. Cool. So, buy now, pay later is exactly what it says. It's buying now and paying later. If you go to many websites now, including Amazon, you have an option to purchase something. So, let's take Shivam's example. If you go to buy a Peloton bike, along with paying through credit cards and through PayPal, you may also have an option to pay through, let's say, is it Affirm with Peloton? Yeah, is it Affirm? It's
Yes.
Affirm is one of the companies. And you can pick that option and then you can split your payment in multiple installments of weeks, months, whatever options they have. It gives users the power to purchase expensive items by breaking it down into installments. Cool. So it's buy now, pay later in installments. That's the product. Now, very common questions coming in people's mind, how it's different from credit card, what's going on here. We'll answer all those questions in this pod today. So tell us more, man. Is this a new concept or what's new about this?
Yeah, so it's actually not a new concept. I mean, even if you don't go back too far, the companies like Klarna are actually, like 16 years old, right? They have 90 million users. Then there is Afterpay, which is almost like 6 years old at this point, and they have like almost 11 million users. So when you start digging deeper, you realize that the conceptual idea is basically the same. The credit is the product. The innovation is happening more on how you deliver the product, right? This product was never delivered so close to the customer, and now it's basically right at the point of purchase, which is where the real innovation comes through.
Got it. What do you mean by it's credit as a product? Can you explain that a little bit more?
Yeah. So ultimately, if you look at what they're selling, what is Klarna selling, what is Affirm selling, they're selling you a way to split your purchase into 5 different or 4 different installments, and all of this ultimately comes down to how do you give somebody the ability to pay today and then buy today and pay later, right? Break it down into 0 APR installments.
So that's the credit part of it. Like they're giving you credit.
That's it.
And that's what you mean by credit as the underlying product. Makes sense. So let's say, like, by the way, I didn't know that Klarna has been there for 16 years. So in terms of technology, it's pretty old, but in terms of financial world, it's pretty new, right? Because Amex is like a 100-year-old company and so on and so forth. But I completely agree. It's pretty long in terms of the tenure of a technology company. Now, coming to the actual story, which is, if these are old concepts or has been there for some time, let's say for a decade, what led to the sudden growth of these companies being Klarna, Affirm, Afterpay, and so on and so forth?
Yeah. And so I think to dig a little deeper there, you have to realize what changed. So between a credit card and between something like a Klarna, the point of purchase credit is what is different. What ended up happening between, say, like the late 2000s and early 2010s is there was a massive growth in e-commerce, right? So people shifted from going to a retail outlet, a brick and mortar outlet, to actually purchasing on Amazon, purchasing on eBay, purchasing on a lot of different places. Right? The browsers became big, mobile phones became big, the API solutions became big. So all of this technical advancement is what pushed some of these solutions through, right? They were the ones that actually drove the growth. Because if you think about it, how are you going to give an experience of point of purchase to a person who's in a retail shop, right, versus who's on eBay or any other e-commerce website? So it's much easier for Klarna or Affirm to give this experience on a browser. So I think that's what changed, and that's what pushed them through the roof, right?
I think we're talking about credit as a product. So I think the common product that comes to our mind right now is a credit card. So Shubham, how is this different from a credit card?
Well, yeah, that's a really great question, right? So if you actually did a little bit of research, you could basically find the same kind of solution provided by a credit card too. You could go into your statement and you can find one of the transactions and say, I want to pay this over 4 installments, and they'll allow you to do that. What's different is the number of clicks. Like imagine the amount of clicks you have to go through to find that transaction, to be able to ask the bank, and maybe they have an approval process which you have to wait up for, versus this is super easy. You just do it right at the point of purchase when you're actually purchasing what you wanted to purchase. So that's the major difference, right? It's the hindrance goes away. Like it's much easier. The experience is much richer.
Fair point, right? If this was already there in credit cards, it's a better experience in these new companies. But I'm just wondering, why did not credit card companies easily build this product or quickly surface their product like the way Affirm did, which started like 6-7 years back? What was the big challenge there? Even now they don't have it. So what's going on there?
Yeah. So again, like if you think through what is going on here, the innovation is not really happening on the credit front, right? Like the underlying credit product was always existing. Banks were providing you different credit cards, and you could use that. The innovation is happening on a technical front, right? And if you think about why banks have always kind of lagged in this space, is because they're too big. This is not their niche. Banks are not tech companies. It's very hard for them to innovate in a technical niche. And so usually they lag behind in certain places like this. And for them, it is not a very worthy investment initially when it's not been proven. So usually it's the startups that come into the space and prove the validity of some ideas.
Got it.
So now that we've covered a lot, why don't you just break down the strategy for us? What is it that these guys do to make money? What the product strategy looks like?
Cool. To understand the product strategy, to break down the stakeholders in the entire journey of the product. So if you think about buy now, pay later, obviously we think about the users who are coming to use the product to split the payment. So let's call them the users. Then we have the merchants, all these stores who are accepting Affirm, Klarna, and buy now, pay later. I'll come back to what's their motivation, but that's number 2. And third is, of course, these platforms, the buy now, pay later platforms like Klarna, Affirm, etc. So if you look at the ecosystem, users, obviously the incentive is pretty clear. They can purchase an expensive item now by splitting the payment. So their value prop is pretty straightforward. They can now buy a $2,000 Paylit by splitting the payment, which they could not otherwise. They could using a credit card, but they may have to pay expensive APR on that if they don't use the Planet feature there. So pretty clear for them. They can split the payment to purchase expensive item. Cool. For merchants, the value prop is Klarna and Affirm or these Bnpl products. They have proven that if you provide this at checkout, you can increase the conversion on checkout. If you are on the Peloton or Best Buy or Amazon cart at that moment, because you can quickly purchase in installments, it reduces the friction, the barrier to purchase an expensive item. That's the value prop to have these on their platform. So that's their motivation to use this product, and it's a pretty clear strategy. The more, if they provide, the more merchants provide this, of course, they can see improvement in the conversion, impacts their profits directly. Platforms is the threefold strategy. They want to get as many integrations as possible. They want to be logos or preferred mode of payment in as many websites as possible, like Amazon, like Paylit, and so on and so forth. Second, they have very low cost of acquisition because all the acquisition happens on the merchant side, which is on Amazon. The customer comes, their customer, and then because they have an integration, they can actually get a very, very low cost. In fact, nothing. The third thing they're exploring is primarily coming up their own marketplace. They're coming up with their own e-commerce version of platform where they are showcasing all the items, all the merchants that they support. So the transaction can happen also on their side. So these Bnpl platforms are threefold strategy: get more integrations, reduce the low cost by having more transactions. The third is open up their own shop / e-commerce platform with all the products from their merchants and let the transaction happen. So that's how they are really scaling and creating the ecosystem. So I think as we go deeper, Shubham, I feel my concern with this model is, how does it work? Because if it's a credit product, is there any credit score involved here, or anybody can get this credit and move on? What's going on here?
Yeah, I mean, that's the $1 million question, isn't it? I mean, at the end of the day, if you're a company that gives out credit for whatever reason, you have to make sure that you don't have more than X number of defaults, because that just breaks down the ultimate underlying business model. And I'm pretty sure there's soft checks that are going on here. But to be honest, I think if you look at the numbers, it's very interesting. They are not really, you would think that these merchants or these companies are actually focusing on people with lower credit scores, but that's not the truth. Actually, more than 65% of the people actually have credit scores in 700s ranges, right? Which is very interesting, because these are the same people who are likely to carry credit cards. So, you know, they also have credit cards, but they're still using Klarnas and the Afterpays of the world.
Interesting. But how do we know they have 700 credit score? Is there a credit check that happens when they pay through these platforms, or is just that it's a self-selection where it's just that the users ended up becoming high credit score users?
No, I'm pretty sure there's a credit score check that happens, and then there's also, as you said, right? If you're buying a Peloton, you're more likely to be somebody who's making a lot of money, or who's also who has the capacity to pay for the Peloton, and then you end up like using the 4 installments for some reason, right? So there's self-selection that happens, and then there's also credit checking that is happening in the background.
Interesting. So I think when we discussed, you mentioned what is the definition of a good customer from a bank perspective for credit card. What was that? Like, can you just break it down for me? I forgot it was a pretty interesting thing you shared with me.
Yeah. No, definitely. I think there was this case study we read like last year, and we were thinking about, if you are a company that provides credit as a service, who's your best customer, right? And so then you ultimately, when you think through it, you would think that a person who would actually pay you back, or you would think that somebody who has a high credit score. But when you dig deeper in it, you realize that what you're really looking for is a person who uses your credit card often and does not pay it back in one go, rather pays it back in installments. And also more than likely to pay you the APR that is attached, because that's where you make the money.
Got it. So you're saying I would have thought a good credit card customer from the platform perspective, from the issuer perspective, from the bank or the perspective of the credit card company, is someone who defaults. But it's not about defaulting. It's about delaying the payment, but ends up paying at a certain rate. So you're very sure the money is coming from those people. Interesting. Awesome. I love that. So what is that? How does that translate into this world, in the Bnpl world? Does the same construct apply here? Who is a good customer from a let's say, a firm perspective? Because if a firm keeps giving money, I mean, in terms of splitting the payments, how are they making money? Like, what is their business model? Sure, they get a cut from the merchant because they're reducing the cost of acquisition. I mean, they are reducing the cost of transaction, hence because conversion is improving. What else? How else do they make money? Of course, from the defaults, right?
Yeah, from the defaults. And I think like I'm pretty sure there's some sort of an APR attached to if you miss one of those installments, right? And so if I were them, what I'm going after is somebody who can pay it back, but once in a while might miss a payment here and there and pays the APR. Well, that's just as additional interest that I get on the money that I've given somebody.
Got it. I think when it comes to fintech, it just gets pretty interesting. I think it's sometimes very hard for me to understand where is the catch, and there's always a gotcha somewhere, because otherwise it's just a technology platform. How do you make money? Like it just becomes hard if there's no APR attached, which is not true. There is some default. There is some guardrails, so you don't default the payments. Cool, Shivam, go ahead. Yes,
and that's that. Yeah, and I think like that goes back to the initial comment I made, right? Like that, like if you really look at this, credit is the product.
Mm-hmm.
Right? That's where they're making the money. That's where the business model really comes through.
Got it. So Shivam, moving on now, like let's talk about. Let me repeat what we just just shared. Bnpl is a credit product. You can buy now, pay later in installments. Fair enough. How do they make money? The platforms make money by charging some sort of a conversion fee or pay per transaction from the merchant's perspective. Merchant, for them, it's good because, if you add this, more users will convert on the platform. It's a risk product again, so credit matters. A good user from a Bnpl perspective is who pays, let's say, misses one and pays the next one, but not defaults going after thereafter. Fair. So all good. What's the future? We are seeing a sudden dip in their valuations, as I mentioned earlier. We're seeing sudden drop in the market capitalization of these companies. The hype is slowing down. So my question is, how do you see the future of this industry, of the buy now, pay later industry?
Yeah, I think definitely there are headwinds, right? If you look at historically how some of these larger organizations have innovated, they are not the first ones to come into the market, but they usually utilize acquisition as innovation kind of strategy, right? Like they come in and they see, let the product be tested, let the technology be tested, and then they kind of go acquire somebody who's doing it right. So there is a very high chance that one of the big banks or the big tech firms is going to come in and swoop one of these companies in, or swoop one of the other smaller companies and then just build it up because they have the resources to do that. The other part of this is that now that it has been tested, it's very easy for any e-commerce giant to just spin up their own solution, right, in-house, because they know how to do it. They know people like it. They know there are customers who want it. So there's also a validation that has happened in the market, right? So it's very easy for them to do that. And then banks, at the end of the day, they are the masters of, innovating on credit. So I'm pretty sure somebody in some big bank right now is sitting and figuring out how to actually innovate in the underlying credit product too. So that's another kind of headwind that might hit these companies.
Interesting. So you think there'll be the incumbents will jump in, the banks first will jump in some form, either buy or either build or buy it, like, acquire some company. I think it's fair. I agree with that. And the second is, of course, the e-commerce giants should jump in. Like, why not? It's a very logical extension of their product. If they already have a financial wallet, why not extend this further? I love it. What can I add to my future? I think from my perspective, I have never used any of these products. I was about to use, but not to split payments, because I feel if I cannot afford in one go, I'll not buy that. It's just my way of looking at my affordability. My prediction is, with the current economic situation, the default rate will go significantly higher than what these companies had ever imagined. So I see some sort of consolidation happening in the process, where somebody will write off these and acquire the technology to then scale it post recovery of our economy, if you will. Same concept as yours, like a large bank will acquire, but my angle here is I do think the default rate will kick in here because of I don't think they're as sophisticated as the bank who have a very strong risk management or risk technology built in with the data they have from the past, from the history they have. So I think that's my observation of the market, and I think that will kick in very soon. I also feel that's another way of thinking about why the valuations are tanking in right now because of the risk of the bad debt they have. That's number one. Number two, I believe, is I do think as an experience, it will remain there. Like, I like the experience. Generally, for me, if it was a PayPal experience, I would still use it. For instance, if a firm says you have an option to split payment and you have an option to pay it one go through your bank, not using a credit card. So it's an online technology to just pay. So it's basically merging PayPal with Bnpl as one product. But because Affirm, Klarna, Afterpay are already there with these merchants, now they offer two types of payments. One is you can split your payment. Other is you can pay it one go. So I feel they'll merge the two worlds will merge together. One, the world of BNPL, and the BNPL companies will start offering PayPal kind of checkout experience backed by any other wallet. Then I feel there is somehow they can scale in the future based on the current momentum they have and the merchants they've acquired in future. But I don't see BNPL to be a solo or by the product in the future in the current form.
Look at historically, right? These things change very fast. So we are in a very fast moving kind of technical cycle. So I'm sure somebody's going to come back with something else and innovate on top of this solution too. So.
Awesome. Fantastic. Great chat, Shubham. I think this is amazing. It's a hard topic. Fintech is hard, man. It's not easy at all, but I love the depth you brought in. Sure, our users will get some insights from this pod. Love to have you back next time. So thank you so much for sharing the insights, and see you soon, man.
Thanks, Mayank. Thanks for having me. It was really amazing talking to you today.
Lovely. Thank you. Bye.
Bye.